Anyhow, chapter 7. So here I'm going to show you for this profit, how we're dealing with the profit in the depreciable assets. When we're dealing with the intercompany transactions, that's for the purpose of consolidation only. So here, on the profit for the depreciable assets, what we have to consider is the allocation of the acquisition price and other possible alternatives, how to do the consolidation, and how to eliminate the intercompany sales purchases and unrealized intercompany profits on the inventory and in the land. So we're going to have two dealing here with the depreciable assets only. We already saw last on chapter 6, we deal on the undepreciable assets, which is the inventory. Now we're dealing with the depreciable assets, which is the one that fall in the category property, plant, equipment. So in this case, the parent and subsidiary often redistribute depreciable or non-depreciable assets between each other. Those transactions, usually those are recorded at the market price, usually, but sometimes can be different. Now, in this case, the selling company will record obviously gain or loss on sale, and the buying company we're going to get the asset, and usually that will be over the initial purchase price. That's the whole point of transferring depreciable assets from one company to another company. And then it's going to use that price to claim the depreciation. The gain and loss of those intercompany assets will be unrealized. It's going to be unrealized since those assets are within the group of the company. So as long as the asset stays within the group of the company, anything that happened in the transaction of the sales or purchase on the gain and losses, it's going to be unrealized until the asset is sold to the third parties. Now, in that case, effective gain and losses will be eliminated, and objective is of elimination is we to bring the companies to the point that they're dealing only and only with the third parties, not with between each other. The intercompany sales on those depreciable assets at profit or obviously they're going to resolve some the consequences will be depreciation, and depreciation will be recorded by the buying company, the company who acquired the new assets. That's the company that's going to use that depreciation for deducting for the expense deductions. Now we have different scenarios here. One is let's say the buying company has a different cost basis for the original cost paid by the seller. And the other one is therefore the amount of depreciable recorded in the buyer's book will be greater than the depreciation that normal way is going to be recorded. For example, let's say we're buying a laptop, or again, I'm going to go with the laptop again. We're buying a laptop for $1,000, and then we're selling to the subsidiary for $10,000. Now, subsidiary, obviously, we're recording the $9,000 gain here, but subsidiary is going to play with that $10,000, and they can record the depreciation based on the $10,000, not on the $1,000. Now, what's going to happen? That incremental depreciation, which is in the position of that's not based on the historical cost, now has to be eliminated. So what that means is, even though we sell the laptop for $10,000, the subsidiary is going to still record on the consolidated statements. We're going to eliminate the purchase price of $10,000, and we're going to bring the asset to the original cost, which is $1,000. And any depreciation that has already been recorded by subsidiary is going to be eliminated And the original depreciation was gonna removed, and we're gonna record the depreciation based on the $1,000 and $1,000 only, nothing more, nothing less. There's example here. So now on the depreciation now, on the statements of the each company, that transaction is gonna stay in the statement of the each company. The $10,000 computer laptop's gonna stay in the books of subsidiary. They're gonna still doing their financial reports based on the $10,000, but for the consolidation purposes only, we're gonna eliminate that transaction and bring it back to the original cost. So there will be income tax effect if the income tax on the unrealized gain and losses, that will affect the net income. That's going to create a deferred taxes, which is computed on the outstanding balance of the unrealized gain and losses. That will be the balance that based on the sales, which we're not selling to the third parties. Upstream gain and losses. So to allocate the portion of the unrealized upstream gain and losses on the depreciation and taxes on the non-controlling interest, that will be the problem here. If we have an upstream, that means subsidiary is selling to the parent. If subsidiary not fully owned and have a non-controlling interest, that transaction of the transferring the depreciable assets is going to affect the non-controlling interest as well. Example will be, let's go through this example. Example will be, again, purchase the equipment for $1,000, which has a 10 years useful life, and then parent automatically sell it to the subsidiary for 1,500. Now, in this case, the parent have to pay the taxes on the $500. If paying the 40%, that will be $200. That will be unrealized $500 gain, which the parent's gonna show on the statements, on the parent statement. That will be eliminated for the consolidation because that's gonna be unrealized gain. However, the parent still gonna have to pay the taxes. Don't get me wrong here. The parent pays the taxes to the government because that's outside, that's third party transaction. So what will be the journal entry? Parent's gonna record the following entry. First, the parent's gonna get the cash, 1,500. The parent's gonna show the equipment going out and again $500. Then the parent's gonna have to pay the taxes on the $500, income tax expense, income tax payable. Now, for consolidation purposes, we're gonna eliminate unrealized gain. And since the gain is unrealized, we have to remove the tax expense and put it as a deferred taxes. Now, if the parent using the equity method to account for the subsidiary, then we have to do the following journal entry to record the parents in the parent general ledger. Now, in the parent's general ledger, that's going to be recorded. We're going to have this investment income, which is going to go with reduce the investment income, and we're going to reduce the investment in subsidiary with $300 to eliminate that. Now that will be the net, the gain of 500 minus the deferred income taxes. Now on subsidiary record, subsidiary obviously is going to record the equipment of 1,500. They pay cash to the parent, 1,500 cash, and then the subsidiary is going to start showing the depreciation based on the 10 years of $150. Now, for consolidation purposes, if the parent has not sold equipment, they will have to record only $100 depreciation. For that reason, on the consolidation, when we're doing the consolidation financial statements, we're going to remove the extra $50 that subsidiary recording as a amortization expense. So we're going to reduce the accumulated depreciation with 50, and we're going to reduce the depreciated expenses with 50. And we're going to bring the depreciation to the reality that has to be on the initial stage where the parent purchased the asset and amortizing the asset over 10 years. Now for the income tax expense to match the depreciation, because remember once we put the depreciation expense on subsidiary books, that's $50 extra, $50 on the depreciation expense. That's gonna reduce the income tax as well. With 40%, that will be $20. So now we have to remove that income tax expense, and actually in this case we're gonna add the income tax expense on the subsidiary level, and we're gonna reduce the deferred income taxes that we create on the first place. And that's gonna stay the same until the subsidiary actually sell the assets to the third parties. Those are the adjustment entries that we have to do for those depreciable assets. And again, now this example is for downstream when the parent sells to subsidiary. If we're going upstream, we have to be careful because on the upstream transaction, if there's a non-controlling interest, we have to show the effect of the non-controlling interest as well. That will be only thing that I want you to know. Again, I'm not going to examine you on this. I want you just to know this for the depreciable assets and the effect on the depreciable assets on the consolidation and the subsidiary and the parent level. Once we know this, that's all I want you to know from this chapter. Next thing, the intercompany bond holding. I'm not going to spend time on this because that's not going to be examinable. So with the midterm, once you finish your midterm, the consolidation is over. Now the next thing that I want you to see is the chapter 8. Now in chapter 8, just briefly mention what's happening in chapter 8. But again, a very small portion here will be examinable through if it's something that will be only through the multiple choice questions, nothing else. So in chapter 8, what we have here is consolidation for the cash flow statement and changes of the ownership. And on the cash flow statement, we're not getting the cash flow statement. What I want you to understand here is we're not going to get the cash flow statement of the subsidiary and the parent and then try to consolidate those one. No. What we're going to do is we're going to consolidate the parent and subsidiary income statement and balance sheet. And once we have those one done, then we're going to prepare by ourselves the consolidated cash flow statement. So again, if we're using the indirect method, first we're going to eliminate for the non-cash items, and after that, we're going to go through the changes in the owner's capital, and that will be the cash flow statement. That's all I want you to know about the cash flow statement. So we're not consolidating the two cash flow statements. We just consolidated the income statement and the balance sheet, and from the income statement balance sheet, we're preparing the consolidated cash flow statement. On the statement of the ownership, now we already know how the ownership changes when the parent buy additional shares. That's going to change the ownership. When the parent sells the shares, that's going to change the ownership. And when the subsidiary issue additional common shares, that will affect the ownership or may not have effect on the ownership, depends on the portion of the how many shares the owners owns from the subsidiary. If it's fully owned, then that's not going to change anything. And if subsidiary purchase some of the common shares from the non-controlling interest, only that's going to affect parent ownership. The parent percentage of the ownership can change when the parent buy or sells shares of the subsidiary or when the subsidiary issue or repurchase shares. Now, anytime when the parent percentage of the ownership increases, that will be account for the transaction as a purchase, and every time when decreasing, that will be account for transactions as a sale. So let's see what else we can get from this one. The ownership increasing and ownership decreasing. We're not going to spend time on this. Let me see, is there anything else here? Consolidation of the cash flow statement, we said, I already told you what I will need to know. On the preferred shares outstanding, I'm not going to test you on those one. Now here, this is the part that will be tested on the test. For the establish direct and indirect holdings and control. Now, the parent can directly own the subsidiary or indirectly own the subsidiary. So on this diagram, we're having the both direct and indirect holdings. So first, in the first diagram, we see the company A owns 70% of company B, and at the same time, the company A owns 60% of company C. Now, obviously, company A have control of each of the company B and C. This is direct control. Company A directly owns 75% of B and 60% of C, which is more than 50%. So we have here direct control. Now let's see the indirect control. The indirect control will be G, a subsidiary of F. But F is a subsidiary of E. Now, since E owns 90% of F, and F now owns 70% of G, we can say that company E, indirectly have control over G. Next example will be, for the indirect control, again, will be company J, company L, and company K. So J owns 60% of K, which definitely J has control over K. Now J also owns 25% of L. At this point, J have not control, but what was that? Significant influence. J has significant influence in L. Now, K owns 30% of L. Now, even though, watch this now, if we have to calculate how much J actually owes from L, it's going to be less than 50% because J owes 60% of K and K owes 30% of L. So 30%, 60% that we owe from K times 30% that K owes from L is going to give us a number plus the 25% that we directly owe from L, and it's going to give us total of 43%. Now, we're going to forget that calculation and we're going to do different calculation. We're going to say, okay, J has control over K. K owns 30% of L. That's 30%. Plus J owns another 25. That's 55%. So then we have the indirect control of the voting shares. So direct calculation is not going to be irrelevant in this case. And we're going to say in this case that we have indirect control. Remember this because again, this one will be tested on the quiz. So that's for the interpretation of financial statements. There will be no questions on this. And that's all about chapter 8 that I want you to know. Again, the indirect control, direct control, and indirect control, and how to calculate the percentage if you need it. That's all I want you to know here. Now let's see from chapter 9 what we can extract from chapter 9. That will be other consolidation reporting issues, and the other consolidation reporting issues here are related to the specific purpose entity. Now, specific purpose entity, that's a very interesting vehicle, I would say, to create specific business activities. Now, what we're going to do, we're going to use the assets, going to transfer them to the specific purpose entity. And once we do that, we're going to be called sponsor. And then specific purpose entity can secure a low-cost debt financing from the sponsor because of the credit risk. So what we're saying is, if the company have high credit risk, in order to clean that risk, the company is going to open a new subsidiary or new company, which is specific purpose entity, and that entity is going to apply for the loan. Since haven't applied yet, this is specifically an absolutely new legal entity, they would be able to obtain some low interest credits or favorable credits. Obviously, specific purpose entity will be restricted on their activities. And with the debt proceeds, specific can then pay the sponsor for the transferred assets. So basically, what's happened is, watch this. The sponsor, which is the company that has a bad credit history, transfer assets to the newly opened corporation. Now, the newly opened corporation doesn't pay for the assets yet. And they use the assets on the balance sheet to show the bank that they have assets. They're applying for loan. The bank approved the loan. The special purpose entity get the money. And with the money that they get, they paying back to the owner for the asset that the owner transferred in the first place. So seems like the asset that the owner transfer or the sponsor transfer in the first place, it looks like a capital, but totally not. Because once the special purpose entity get the cash, that cash goes back to the sponsor. So those are the variable interest for the special purpose entity. They can obtain the guarantee of the debt, subordinated debt instruments, variable rate liability, lease residual guarantee, non-voting equity instruments, and services. Who's bearing potential losses and returns? Now, if the special purpose entity cannot repay the liability, sponsor has to repay that liability. If the special purpose entity cannot repay the senior debt, the sponsor has to pay it. Now, the sponsor, as a holder of the debt, may participate of the return on the special purpose entity. Now, if the value of the lease asset decline below the residual value, then the sponsor is the one who's going to take the shortfall. For the non-voting equity instruments, the sponsor, as a holder of the debt or equity, may participate in the residual profits. And for the services, the sponsor, as the service provider, receive the portion of the residual profit in this case. The primary risk and the reward of the ownership of the special purpose entity may not be based only on the equity ownership, but rather on the variable interest, which is conveyed by the contractual agreement with the sponsor. In that case, the equity investors of the special purpose entity typically will receive a guarantee rate of return which standard dealing with the special purpose entity. That will be International Financial Reporting Standard 10, which dealing with the consolidated financial statement. So entity must consolidate the entities that is controlled regardless of the mean of obtaining control. Is it for the strategic purposes? Is it the special purpose entity? All those entity has to be reported in the consolidated statement. Many of the special purpose entities are created to perform activities that are part of the reporting entity ongoing activities. And obviously, more risk then will be taken by the sponsor. Control of the special purpose entity is usually based on who direct the key activities in that special purpose entity. So thus most likely that will be the sponsor. And since the primary benefit of control of the special will that will be the sponsor who is the primary beneficiary of control, and that will obtain the future return from those resources. So whatever the special purpose entity earns as resources, that will be directly reflected to the sponsor's earnings. Since the primary beneficiary usually bears the risk of absorbing the majority of expected losses, the liabilities carried by the special purpose entity, and therefore those liabilities should be included on consolidated balance sheet. So whatever special purpose entity owes, that will be reflected on the consolidated financial statements of the sponsor in this case. Financial reporting principles for consolidating require all the assets, liability, non-controlling interest to be initially recorded at the fair value. And when the primary beneficiary gets control of the net assets, the total consideration given is the sum of the following. Now, what if this will be for the primary beneficiary, the fair value of consideration paid by the primary beneficiary and the fair value of the non-controlling interest of the special purpose entity. That's not so important. I want to see something that's, I'm going to test you on the test, on the quiz. Joint arrangements. That will be something that's going to be tested on the quiz. The joint arrangements. This one is important because CPA start throwing questions on this area of accounting, on the joint arrangement specifically. Now, the joint arrangement itself is a contractual agreement where two or more parties undertake an activity together and jointly control that activity. So joint arrangements are established for a variety of purposes and can be established using the different structures and legal forms. And the joint arrangement participants contribute resources to carry on specific undertaking. So in order to have a joint arrangements, again, we have to have a contractual agreement where two or more parties undertake activity together with jointly control that activity. So now let's see which are the form of the joint arrangements. There are two types of joint arrangements: joint operation and joint ventures. So if you have to, so basically on the cases that you're going to see in CPA, they're going to say the company is a joint venture. Now, first, in order to establish it's the joint venture, first you have to establish, is this a joint arrangement. If it's a joint arrangement, if you follow the category in the joint arrangement, then you have to prove that go over the test. Is it from the joint arrangements? You have two options here. Is it going to be joint operation? Is it going to be joint venture? You're going to prove that it's not joint operation. So if it's not joint operation, directly means that it's a joint venture. So what's the joint operation in this case? Joint operation is each operator contributes the use of the assets and resources to the new activity, but they retain the title and control over the assets and the resources. So basically, the operator, whoever get to that type of joint arrangement, they contribute the assets, but they remain the control of the assets. Example will be the case in which one operator manufacture part of the product, second operator complete the manufacturing process, and third operator handle the marketing of the product with the operator using its own asset to perform its work. So in that stage, we don't have the operator don't give the rights and control of the assets to the joint operation in this case. Let's see what's the difference between the joint operation and joint venture. Joint venture, now this still arrangement where the parties that have a joint control give the rights to the net assets of the arrangements. So that's the huge difference between the joint operation and joint ventures. In the operations, operator remain control, where in the venture, they give the control to the new entity. In this case, we're going to have a new separate entity. The entity, as a party of the joint venture, when the separate vehicle has the rights to the assets and responsibility for the liability. In joint venture, the venturers now, not operators, because if you have a joint operation, that will be operators. If you joint venture, the companies that are doing joint venture is going to be venturers. Those ventures, we're going to contribute the assets to the separate legal entity now. We're going to open a new separate legal entity, which entity is going to hold the assets and going to have control over those assets. For the accounting principles which involve the reporting joint arrangement, those are in International Financial Reporting Standards 11. And there you can find what's the joint arrangements, what's the joint control, what's the joint operation, and what's the joint venture. So based on the International Financial Reporting Standard 11, joint control is the contractual agreed sharing of control on the arrangements, either operation, either venture, which exist only when the decisions about the relevant activity require the unanimous consent of the party sharing the control. Then the joint operator will be the party in joint operation, and joint venture will be the party of the joint venture. Joint control is like a key feature on the joint arrangements. So in order to have a joint arrangements, we have to have a joint control. And based on is it the joint operation, joint venture, that's going to change the picture. So again, when you start talking about the joint arrangements, first establish that the joint arrangement exists, and if the joint arrangement exists, then define what kind of arrangement it is. Is it joint operation or is it a joint venture? So let's go for the accounting for the joint operation first. International Financial Reporting Standards 11.20 deal with the joint operator, which must recognize relation to its interest on the joint operation. First, they have to establish assets, including its shares on the assets held jointly. Here we holding the assets jointly. We're not releasing in the joint operation, we're not releasing the ownership of the assets. We holding the assets when we're holding them jointly. Liability, including the shares of the liability which are included jointly. Revenue from the sales of the shares of the output arising from the joint operations. Shares of the revenue from the sales by the joint operations, and expenses, including its shares of any expenses, including the joint operations here. So everything that the joint operation generate, it has to be affected on the operator's statements. Now let's see for the joint ventures, accounting for the joint ventures. Again, still International Financial Reporting Standard 11 dealing with the joint venture. And also we have the International Accounting Standard 28, which also dealing with that. Now the venture is going to recognize its shares of the income earned by the joint venture. So as you can see in the first place, we're pulling the interest that we have, assets plus a share of the liability which we're holding jointly. In here, we're going to, everything is based on the percentage that we are into that joint venture in this case. So whatever the joint venture generate, the percentage of that income or that outcome that the joint venture generates, it's going to belong to the joint venture. Now, the following arrangements are required for the share for the acquisition, amortization, acquisition differentials. Unrealized profit from the intercompany transactions. We're still going to have the intercompany transaction in the joint venture. And contribution to the joint venture. Now, for the joint venture, the venture shares of the intercompany assets profit has to be eliminated, having in mind that the joint venture is a separate legal entity. On the date of the formation of the joint venture, instead of contribution cash, the venture contributes non-monetary assets and receivable and receive interest on the joint venture. And the assets contributed have fair value, so which is greater to the carrying amount. Those are recorded on the venture, the joint venture statements. Now, the requirements of the International Accounting Standard 28 deal with if it will be appropriate for the venture to record the gain from the investing those non-monetary assets into the joint venture, and if have to, how those gains should be recognized. For example, if the venture carrying assets, let's say again with the laptop $1,000, but the market value of the fair value of the laptop is $1,200, then definitely there will be a gain of the investing amount more than the carrying value of the asset. So how this is going to be recognized, and we're going to find out on the International Accounting Standard 28 in this case. So International Financial Reporting Standard 28 requirements are the investment should be recorded at fair value of the non-monetary assets transferred to the joint venture. Only the gain represented by interest of the other non-related ventures should be recognized on the date of the contribution, and only if the transactions have commercial substance. Now you have to remind yourself which transaction actually has commercial substance. The one that replacing asset which is significantly different cash inflow than the previous one. Usually on the question is going to say, is there commercial substance or not? If the transaction does not have commercial substance, then the entire gain is considered to be unrealized unless the venturer receives assets in addition to the interest of the joint venture. Basically, the same way that is treated when we're replacing one asset with another. We're chasing is there commercial substance or not. If there's no commercial substance, one asset replacing the other one. But in this case, we're gonna record unrealized gain in this case. So the other thing in the other requirements is the portion of the gain represented by the venture-owned interest should be unrealized until the assets has been sold or unrelated outside to the joint venture party. And if the loss result from the recording of the investment, the portion of the loss represented by the interest of the unrelated ventures is recognized immediately into the income. Who are the investors in the joint arrangements? The investors in the joint arrangements is the party to join the arrangement, but they don't have control over the joint arrangements. So that's one interesting thing is we're going to have the joint operator, we're going to have the joint venture, and we may have investor. But the investor has no control over the joint arrangements. We need to differentiate again the ventures who have a joint control and investor who have no control whatsoever. Disclosure requirements for the joint ventures for the statements. The nature, extent, and the financial effect of the interest of the joint arrangements, including the nature effect of the contractual relationship with the investors, with the joint control or joint arrangements. The nature and the changes of the risk which are associated with the interest of the joint ventures. And at any point, there might be differences between the tax basis of the asset or liability and the carry amount. So a capital asset's net book value can be different from the tax undepreciated capital cost temporarily until both are fully depreciated. Those will be some temporarily deferred, that's going to create a deferred income taxes. But that will be on the business combination. Now we're moving back to the business combination on the deferred taxes and what's create the deferred taxes. Again, differences between the tax treatment and accounting treatment, which can create some temporary differences which will be deferred for the time being as a deferred liability or deferred assets. Depends on which direction we are. We're not going to spend time on those deferred segment disclosure. On the segment disclosure, that's very interesting because I start seeing again on the segment disclosure, I saw the question from CFE exam dealing with the segment disclosure. Now, when the consolidated financial statement of large and diverse company prepared, a significant amount of detail about the profitability of different products and services, the geographical area in which the is considered operation and its customers is aggregated. So when we have those large, we may have to prepare a separate portion. We can separate disclosure would provide a useful predictive information for the analysis for the financial statements. However, providing individual financial statement of the subsidiaries and consolidated adjustment details may uh, be too much for the investors or for the analyzers. For that reason, we can prepare a segment reporting. We have available segment reporting, which is efficient method to communicate enough but not excessive relevant data. Remember, be very when you're preparing financial statements, and if you have to prepare the segment reporting, be very careful what kind of information you release into the outsiders, the company. You don't want to release too much information about the company. So, which standard dealing with those segments financial reporting? That will be International Financial Reporting Standard 8 required a separate disclosure for segment when one or more thresholds are met. So we're chasing one or more of the following are met. First one is the reported revenue, both external and intersegment, is 10% or more of the combined revenue, internal and external, to all the segments. So if the revenue is more than 10%, we may go with the segment disclosure. Absolute amount of the reported profit or loss is 10% or greater than in absolute of combined reported profit of all the segments and combined reported loss for the operating segments. Next one is if the assets are 10% or more of the combined assets of the operating segments and at least 70% of the company external revenue are reported. So you can see the 10% is the main threshold here. Everything that is above 10%, we might consider separate disclosure only and only if you want to make the financial statements more useful for the users, but not too useful, right? So you have to be careful again. Make it iffy, but not excessive relevant data. Don't go too crazy on the reporting here. Which are disclosure requirements? Factors used by the management to identify the segment. Type of the product services that generate the revenue. A measure of the profit and losses. Total assets and liability for each of the reporting segments. We have to disclose those one. The other thing is each of the following specific amount are included in the measure of the profit. So we have to show the revenue, integrated revenue, interest revenue and expenses, depreciation and amortization if there's any, material income and expense items, only those which are material, equity method income from associated or joint ventures, income taxes and significant non-cash items other than depreciation and amortization. And keep going with the disclosure requirement. As you can see, a lot segment requirements on the segment disclosure. And that's about it with the chapter 9. And I'm not going to spend any more time on chapter 9. So in chapter 9, I want you to understand that joint arrangements, joint ventures, and the segment disclosures. Those were the key here from the chapter 10. And now you have all the information that you need for your quiz number 2. The last thing that I want we to go through today, so we can start working on your assignment, the next assignment, if you want to. Since we are very close to the end of the semester, is the next chapter, which next chapter is chapter 10. And in chapter 10, now it's getting a little bit more familiar. All these things that you see up to this point was maybe were familiar for you or maybe not, but this chapter 10 is definitely familiar for you. So here that's a little bit more, how can I say, we're going to the area that will be tested now for the final exam. Chapter 10, 11, and 12 will be tested on the final exam only. And you're going to have questions from all these chapters, chapter 10, chapter 11, chapter 12. So chapter 10 dealing with the foreign currency transactions only. So what we have to find out here is that many companies conduct business in the foreign currency as well as in Canada. There's no specific accounting issue arise when the parties involved in the import and export transaction agree to payment in Canadian dollars. So as long as the partners that we're dealing on the import-export agree to pay in Canadian dollars, there's no issues. Since it's Canadian dollar denominated transaction, the company will record the foreign purchase or sales in Canadian dollars the way they're recording it for the domestic purchases. So it's nothing gonna change. That will be one of the things. Now, the problem is that not always happen this way. So some of the companies actually dealing with the uh, transactions in the other countries with the vendors and doing purchases and sales in the other countries. And then those countries, they don't agree to pay and denominate everything in Canadian dollars. That's where the problem is. When the agreement calls the transaction to be settled on the foreign currency, then we can have two things. If the transaction is a purchase, then the Canadian company have to acquire foreign currency in order to pay for the purchase. And if the transaction is sell, then Canadian company has to sell the foreign currency in order to convert it to Canadian dollar. Now that once we have the foreign currency denominated transaction, that means we're dealing with the foreign currency that has to be converted one way or another into the Canadian dollar. Either we need the foreign currency to pay the vendors, so we're converting Canadian dollar into the foreign currency. Either we receive the foreign currency, which has to be converted into the Canadian dollars. Now, of foreign currency denominated transactions accounting issue arise when the value of the Canadian dollars changes relatively to the foreign currency. Why the value can change? Because of the timing. Obviously, the time passes. So if we purchase today, so watch this. If we purchase today, let's say, what will be that? Some facial equipment from France, facial makeup and anything like that. Perfumes from France. And we have to pay 800 euros. If today we converted Canadian dollars into euro and we pay the euro today, there will be no implication. Whatever the exchange rate is today, that will become the value of the goods. That will be become a value of the transaction. Transaction will be denominated in Canadian dollars. Our problem is solved. The problem is of the timing, means that the purchase is not always is accompanied by the payment. So we purchase the perfumes first, and 1 month later we make the payment. So the date of the transactions statement on which the financial statement are reported the foreign currency denominated receivable and payable, and the date of the receivable the payment of the foreign currency denominated receivable payable. So we're gonna record the transaction on the financial statement on the day the transaction happened, for the purchase, and then we're gonna record the same on the financial statement when the transaction happened for the payment. And if those two transactions happen on the different days, we're gonna have a difference in the denominated currency, which will be in this case Canadian dollar. So let's go now. Recording foreign currency denominated transaction require the use of the currency exchange rates, obviously. Foreign currency exchange rate fluctuate because of so many things, either because of there's so many things. Inflation, political situation, I don't know, sometimes it's just rumors. Everything can affect the foreign currency exchange rate. Now, there are two exchange rates. One is the called direct rate, the other is called indirect rate. Direct rate represent the cost in Canadian dollars to purchase 1 unit of the foreign currency. That will be how much Canadian dollars we have to pay for €1. That will be the direct rate. And we're going to have the indirect rate, which will be the opposite. How much of the other currency we have to use in order to purchase 1 Canadian dollar. So if you're purchasing 1 Canadian dollar, that's an indirect rate. If you're purchasing one of the other currency, that's a direct rate. Then we're going to have a different rates. We're going to have a spot rate. Spot rate is the rate of the exchange on the currency today, or most likely at the day of the transaction. There is, in fact, a separate spot rate for purchase and sales. Obviously, there was different rates for the buying and selling the same currency. That's how that's why can easily lose money by buying and selling the same currency. And since the rates are different, you can, by the end of the day, you can lose all your money. Now, the foreign exchange contract is a tool that can help you to mitigate the foreign currency fluctuation. So the foreign currency exchange contract will be agreement between financial institution, usually bank, and the customer company to exchange the currency on the specific date at specific rate. You can even specify the amount that you're going to exchange. Now the forward rate will be the rate which will be on the foreign exchange contract agreement, or that will be the rate that is agreed upon by the customer and the financial institution, which exchange is going to happen on the future date based on the foreign exchange contract. International Financial Reporting Standard 21 does not include a requirement on the exchange rates to use by the entity when the spot rate is not observable. Now, what's going to happen if we're dealing with the currency which we cannot find the spot rate? In this situation arises when there is no exchangeability between the currency. We're dealing with the Martian, some kind of currency. Then there's no Canadian versus Martian, whatever currency is. Now, the exposure draft was published in 2021 on lack of exchangeability. The other thing is the digital currency. Now, I see some of my colleagues start teaching the digital currency accounting. The interesting idea with the digital currency is that that's a new development in the world, obviously, and it's going to get more and more popular, I guess. Now, the digital currency is a record of the value stored in the distributed database on the internet or within the electronic wallet. Now, the digital currency are not considered to be cash. So if they're not cash, that means we cannot identify them as an asset. Since we cannot identify it as an asset, we have to find out what exactly the digital currency is. Is it, since it's not a cash. Now, the current international financial reporting standards are silent on how those digital currencies should be accounted for. Is it going to be accounted as an investment? Is it going to be accounted as something else? What exactly is going to be? International Financial Reporting Standard is silent. They don't say anything. So for the foreign currency transactions, let's go with the foreign currency transactions. Currency issue can be discussed and analyzed from the many different perspectives. Now we need to differentiate among the denominated, recorded, functional, and the presentation currency. So we have to differentiate between denominated, recording, functional, and presentational currency. So what we're going to see the next slide is that this slide is going to continue next time. So we're going to see which one is what here. Examples of I'm going to make it currency perspectives. Option 1 is the company A, company B. Company A is incorporated in Canada. Company B is also incorporated in Canada. Transactions are denominated in Canadian dollar. In company B, those transactions are denominated in multiple currency in various countries. Recording currency in this case will be Canadian dollar for company A and can be Canadian dollar for company B. Functional currency, both Canadian. Presentational currency, both Canadian. Method of transaction for the company A, since everything is Canada, not applicable. But for the method of translation that we're going to use for company B will be functional currency transaction. This is important because the next chapter 11 next time, we're going to start the translation of the financial statements, foreign translation. So now let's go back to the original size of the slides. Give me a second. Now the Canadian company typically going to use Canadian dollar as a recording and presentation currency. All transactions must be translated to the functional currency on the reporting entity. And International Accounting Standard 21 defines functional currency, and the foreign functional currency is the currency of the primary economic environment in which entity operates. And foreign currency is any currency other than functional currency. So again, we're defining the functional currency. Once we define the functional currency, any other currencies are treated as a foreign currency. In the next slide, we're going to list indicators that should be considered when we determine what's the functional currency. And so sometimes it might be not specifically stated in the case, but through the analysis, you have to define and you have to come up with the conclusion, what is the functional currency? Because if once you have the functional currency, that will be your denominated currency. That means any other currency has to be denominated into the functional currency. Now, the factors that's going to be, actually, this slide's going to continue next time. On the functional currency, now we have the sales, we have the operating costs, we have completion and regulation, financing, and operating surpluses. And next time we're going to continue with more. Which one is the evidence that the functional currency is actually Canadian dollar? for the sales price. If all the sales happen in Canada and those sales are denominated in Canadian dollars, Canadian dollar is the functional currency. If the sales happen in the foreign countries and the transactions are not denominated in Canadian dollars, that means the functional currency is not Canadian dollar. That's for the sales. Let's see now for the operating cost. Labor and material are obtained in Canada and denominated in the Canadian dollars. If that happens, then functional currency is Canadian dollar. Labor and material are obtained from the foreign currencies, and those are not denominated in Canadian dollar, then functional currency is not Canadian dollar. Competition and regulations. No, the competitions, all the regulations, competition regulations are Canadian, and companies listed in Canadian Stock Exchange means the functional currency is Canadian dollar. If the competition comes from the outside, from the foreign entities, and the companies is listed in the foreign exchange, then Canadian dollar is not for functional currency. Financing. Debt and equity comes from the Canada and Canadian dollar. Canadian dollar is the functional currency. Debt and equity instruments are issued in the foreign countries, non-Canadian. And the last one here, operating surpluses. Excess cash is retained in Canadian dollar. That's functional. And then foreign excess cash is retained on the foreign currency, so we keep all the cash and everything in the currency other than Canadian. Then Canadian dollar is not the functional currency. Obviously, we have to exercise professional judgment. Which professional judgment? That will be your professional judgment. You'll be the one who's going to tell which one is it. It's important you to the Canadian dollar is the recording, functional, and presentational currency. In this chapter, that's what we're going to do. We're assuming the Canadian dollar is the recording, functional, and presentation currency. A monetary item is converted into cash at a fixed or predetermined amount of currency, and historical rate is the rate on the date of the transaction. First will be historical rate is the date on the date of the transaction. Historical rate is the closing rate. Now the closing rate. So we have, watch this, we have historical rate, we have a closing rate, and we have an average rate. Historical rate is the date on the transaction. Closing date is the date of we're preparing the financial reports. Average rate is the weighted average rate of the historical rates for the period. Where you can find those ones? Very simple. You have to do some effort here. So basically you have to go to our website. Let me show you. And what you can do, you can go with Bank of Canada and exchange rates. It's even given the Bank of Canada exchange rates. When you look in the exchange rates, you're going to see so many exchange rates. We're going to have daily exchange rates. We're going to have monthly exchange rates, annual exchange rates. Daily exchange rates look up to Canadian effective exchange rates, foreign exchanging in exchange inversion, all the information is given. So if you go to the daily lookup exchange rate, so here it's going to give you for which currency. Obviously, we're looking for the, let's say, euro, If we're doing this, then we're using the direct exchange rate in this case because we're chasing how many Canadian dollars we're going to spend for €1. And you can select the range, the custom dates, and you can pick up from what will be that from January. Let's go with last year. You can easily pick up from January 1st last year till December 31st last year. And so not that one. Let's go with the December. Come on, give me December. Oh yeah, that will be. Let's submit this one. And then what we're gonna see is, watch this. We're gonna see the high rate. What was the highest rate last year? As highest rate was on August 21st. What was the lowest rate? And what was the average rate? And you can see this analysis of the exchange rate, how the exchange rate fluctuated during the year. And now, by doing this, what you're going to have is you're going to have the closing rate, you're going to have the date of transaction, and you're going to have the average rate. So basically, you have all the rates that you need for the accounting purposes, if you need those rates. Let's go back to the slides now. Now, according to the International Accounting Standard 21, foreign currency transactions must be recorded on the initial recognition in the functional currency by applying foreign exchange currency amount at the spot exchange rate between the functional currency and the foreign currency. Now, that's why it's very important to establish which one is the current functional currency. Because once you establish Canadian dollar as a functional currency, that means every other currency is foreign currencies. And we're going to apply the spot rate. And we're going to translate the foreign currency into the Canadian dollar, and we're going to record it into Canadian dollars, which is the foreign currency, the functional currency. At the end of each period, foreign currency monetary item must be translated using the closing date. If we keep a bank account in US dollars and it has balance, at the closing rate of December 31st, we have to convert the amount into Canadian dollar on the functional currency. Foreign currency non-monetary items that are to be measured in item of historical cost must be translated using the historical rate. So basically, if we're using the historical cost, on that day we have to go and see what was the historical rate and translate it using the historical rate. Now the foreign currency non-monetary, if we're dealing with the non-monetary item, they are to be measured the fair value must be translated using the spot exchange rate at the date when the fair value was determined. So if we purchase it, we're going to use the historical cost, and then we're going to translate it by using historical. If we're using on initial fair value, then we're going to use the spot exchange rate at the date that the fair value was determined. Individual transactions must be translated into the functional currency at the historical rate. So every time when you have a transaction, using the spot rate on the day of the transaction and using it to translate into functional currency. Translation methods should ideally produce either historical cost in dollars or fair value in dollars, which is consistent with the normal measurement requirement of the financial statement items. Now, many Canadian companies borrow money from the foreign market. Why? Sometimes it's cheap. Many because the capital market in Canada is relatively small. Now, interest expenses in that case, which the company has to pay in the foreign currency, has to be translated using the average of the historical rates to produce a historical price in Canadian dollar. So we're going to use the average of the historical rate to produce a historical price in Canada. So basically, we're not going to go every time the company give us interest on that spot rate. We're going to use the average rate for the year. This is consistent with the normal measurement requirements of to record interest expense at historical values. Exchange gain or losses, which happen on the item translated at the closing rate, but not on the item translated in historical rates. So basically, we may have some exchange gain and losses, but those going to happen when initially transaction was recorded on the historical rate, and at the end of the period, we have to use the closing rate. But if the item, we don't have to on the closing date, we staying with the historical rate, there will be no foreign exchange gain and losses. How can we protect ourselves from the fluctuation? What comes handy is the foreign exchange contracts. Foreign exchange contracts means the two parties, which one is financial institution, the other party is the party who wants to mitigate enter the contract, will agree today to exchange the currency at the future date at the specific price. The forward contract is a financial instrument which must be measured the fair value through the life of the contract. Now, if the forward contract changes, the fair value of the forward contract changes. Obviously, if we change the contract, if the clause to change the contract, the fair value is going to change. Under the net method, no journal entry is required when the forward contract is signed. Therefore, the forward contract is measured at the fair value at each reporting date. The forward contract must be reported at fair value according to International Financial Reporting Standards. So every year we have to report it at the fair value. What will be the fair value? Fair value will be the value at market value at the day of the reporting. So we're going to see the closing date of the date of the reporting. We're going to measure the contract based on the amount of the currency which the contract is, and we're going to measure the fair value of the contract. So what's going to happen with if we have a foreign exchange contract? Now let's imagine I have a contract to buy 100,000 American dollars at 1.2 Canadian. For every American, I'm going to give 1.2. Now, when the value of the contract is going to increase? Every time when the exchange rate between Canadian and US is above 1.2, the value of my contract is going to increase. And every time when the exchange rate moves to below 1.2, the value of my contract will be lower. Why? Because if the date comes, I have to exercise the contract. But if the market value of the US dollars fall below 1.2, then they're clearly losing money on the contract. But if the value of the US dollars increase and go to 1.5, then they're clearly making money on that contract. So hedges, what's the hedges? Foreign currency losses can be significant. So we have to do something to mitigate those losses, if it's possible. What's come handy here is the type of protection which is generally referred as a hedge. Now the hedge can be defined as offsetting the risk exposure, which comes from three types of risk. In the finance, if you don't remember, in the finance there was three types of risks. that can happen. One risk is for the commodity price. The other next risk is the interest rate. And the third one is the foreign currency. So hedge, again, is hedging means offsetting the risk. Hedge instrument is the instrument that help you to offset the risk exposure, which comes from the commodity price, interest rate, and foreign exchange currency fluctuation. Hedge item is the item which, with the risk exposure that entity has taken step to mitigate. So if the US dollar is the one who's going to fluctuate, and the US dollars is the one that we want to offset the risk of exposure, then the US dollars will be our hedge item. Hedge instrument is the item that we use to offset the risk. Now, the hedge instrument can be foreign forward contracts or future contract or options, whatever you want it, whatever instrument you call it. Now, the hedge accounting. Now, since we have the hedge item, a hedge instrument, if that happens, then we're going to have a hedge. We have to have somehow hedge accounting. Hedge accounting is described in the International Financial Reporting Standard 9. And the good thing is that hedge accounting is optional. The entity can choose to apply it or if wishes, but it's not necessary to use it. Now, if the company decides to use the hedge accounting, under the hedge accounting, the exchange gain and losses on the hedging instruments will be reported on the income at the same period as the exchange gain losses of the hedging item. So again, we have hedge item, we have hedge instrument. And exchange gain losses on the hedging instrument will be reported on the income in the same period as the exchange rate gain and losses on the hedging item. If the hedging item have exchange gain and loss, then that means the hedging instruments also going to have exchange gain and loss. The hedge accounting require in International Financial Reporting Standard 9 are less restrictive and more closely aligned with the entity risk management activities. Now, the few hedge accounting requirements in the International Financial Reporting Standard 9 will help the investor to better understand the extent and effect of the entity hedging activity and assist them with forecasting the future cash flow. Then we're going to derivative instruments, such as forward contracts can be hedging instrument, but not hedge item. So now derivative instruments, which is forward contract, is the hedge instrument, but not hedge item. Hedge item is something else. Hedge item can be foreign currency. Remember, hedge item is the item which is exposed to risk. Hedging instrument is the item that we use to offset the risk on the hedge item. Now, derivative instruments is a forward contract. As a forward contract, can be hedging instrument, but not hedged item. We cannot hedge of the fluctuation of the derivative instrument. The quality of the hedge accounting, to qualify for the hedge accounting, the entity must expect that the hedge will be effective and must document how the hedging relationship will meet the hedge effectiveness requirements. So it's a very kind of too much complications, but anyway, that's why probably it's optional. Hedge effectiveness must be assessed. How effective is the hedge? Will be assessed on the inception of the hedging relationship and on ongoing basis. So basically, the item that you purchase, how effective is on the day of the purchases in every reporting period. A hedge is designed as a fair value hedge or cash. So now, how we're going to design the hedge accounting is going to be either fair value hedge or cash flow hedge. Those are the two types. Two types of accounting that we have under the hedge accounting. Fair value hedge or cash flow hedge. So now, I'm not going to test you on this on the fair value versus cash flow, but I want you to know this one because CPA throwing questions on those hedge accounting. Now, there are three types of hedge relationship. Fair value hedge, which is the hedge of the exposure to change in the fair value of the recognized asset or liability or unrecognized firm commitment. And the cash flow hedge is the hedge of the exposure or variability in the cash flow of a recognized asset and liability or highly probable forecast transaction. And if you have a hedge in the net investment of the foreign operation is defined at the International Accounting Standard 21. Now to fair value hedge. Which entity is going to use the fair value hedge and what the fair value hedge means? The entity uses the hedging instrument to hedge against the fluctuation of the fair value of hedge items. So I have the instrument for an exchange contract, which helps me to mitigate the fluctuation of the US dollars. This method will be used when the hedge item will be measured the fair value. Hedge item is the US dollars. The gain and losses of the fair value of the hedging instrument and hedge item are both recognized in profit and loss in the period of the change of the value, with one exception. If the hedging instrument hedges an entity instrument for which the entity has elected to present changes in the fair value in other comprehensive income, then the gain and loss of the hedging instrument are also going to be presented in other comprehensive income. So that will be probably investment, which we have no significant influence. And if you remember on the investment with a no significant influence, we can choose to report it as a fair value through other comprehensive income. Now the cash flow hedge. Cash flow hedge is the entity uses hedging instruments such as derivative to hedge against the fluctuation in Canadian dollar value in the future cash flow, such as future sales. The gain and losses of the hedging instruments is usually reported in the other comprehensive income and subsequently reclassify the profit to profit when the hedging item affects profits. And the hedge of the net instruments of foreign operation, those will be discussed next time. We're going to talk about this for chapter 11. How are we going to recognize the hedging in the monetary item? In the case of this textbook, the hedging item is either purchase or sell transaction. So either we have to buy something, either we have to sell something. That's already occurred, but not settled. The hedging item is the forward contract. Now we have to record transaction, purchase of the transaction, report date in the spot rate. Recorded value of the transaction remains unchanged through the life of the hedge. We have to record the forward contracts at the forward rate at the corresponding payable to the receivable from the bank. So we're gonna have a purchase, either we're gonna have a sale. Financial reporting dates. Now, revenue of the transaction payable and receivable at the closing rate. That's going to trigger gain and losses, which are recorded in the income. Revenue on the forward contracts at the forward rate with the gain and losses into the income. Payable to receivables from the banks, which doesn't change. On the balance sheet, we have to reporting the forward contracts as asset or liability, net of the payable to the or receivable from the bank. Either what we have to pay or either we have to buy to receive if it's asset or liability. And the settlement, repeat the procedure for a statement reporting dates. And record the cash flow at the spot rate. So in that date or the settlement date, either we have to buy, either we're going to receive something. So we have to use the spot rate to translate it to the function of currency. The both cases accounting for the hedge does not result a change to the value of the transaction which happened before the hedge was in place. So let's see if gonna happen. Gonna create some different results. In the case hedge item is so for these textbooks they're using the hedge item is a committed purchase item with the committed purchase and sales transactions. Again, not happened yet. And the hedge item is forward contract in this case. So we're going to record the forward contract as a corresponding payable or receivable from the bank. Later, when the purchase and sell the transaction happen, we're going to revalue the forward contract at the forward rate, recording the gain on the other comprehensive income in this case, not in the income. In this case, we're going to stay with the other comprehensive income. We're going to record the purchase or sell transaction on the spot rate. And then we're going to clear the forward contract. And the balance that's keeping on the other comprehensive income with the purchase or the sale of the contract. So we're going to eliminate the effect of the other comprehensive income from our statements. Between the time of the transaction happen and the settlement, because we're always going to have that time of the when we enter in the foreign contract versus the date of the settlement, which either we have to pay the cash, either we're going to receive the cash. The results of payable and receivable, which will follow the procedure. We're going to follow the procedure of fair value hedge to recognize the monetary item. And then we're going with this hedging highly probable. Now I'm not going to torture you on the hedges. Don't get me wrong. I'm not going to torture you on the hedges, but I want you to know the hedges. In terms of the hedges as a hedging, again, hedging is the offsetting the risk of the fluctuation of either commodity price, either interest rate, either foreign exchange rate, all those three. And what's interesting, we're going to have the hedge item and hedge instrument. Hedge item is the item which is under the hedge, and hedge instrument is the one that protect the fluctuation of the hedging item. So keep in mind those one. Now, what kind of instruments we have here? We're not stopping. We're talking only about the what was the exact name? I want to see the exact name here. Forward contracts. The forward exchange contracts is the only one that is going to be recorded under the hedge accounting. That's why they're specifically stated here. We have the other instruments, which is future contracts and options. On the options, they're very minimum cost, and the options you have an option to exercise this or not. Forward contracts, the interesting part is why we're talking about the fluctuation, the fair value, is because for the forward contracts, you have the secondary market. You can sell it before the date of the stated date on the forward contracts, or decide to keep it. Depends on your needs and depends on the fair value market of that particular instrument. That's why under the hedge accounting, we recognize in the forward contracts. Future contracts and the options are different stories. As you can see, we're not talking about those instruments, hedging instruments, we're not talking about here in this chapter. And that will be all for those foreign currency transactions and foreign currency transactions. Now, for the foreign currency transactions, you're going to have assignment, which is assignment for chapter 10. Again, try to do the assignment because question from that assignment is going to come to the final. And then we have two more chapters, chapter 11 and chapter 12. Chapter 11 is foreign currency translation. So once we see the transactions, now we're going to start translating. What we're going to translate? We're going to translate the consolidated statement from one currency into Canadian dollar or from one currency to another currency, depends on the scenario. So that's what I wanted you to know for today. So today you have enough information to do your quiz 2 and work on your assignment for chapter 10.